Hello and welcome to Enrich Academy. This is Nancy. In today's video, we're going to look into what an NRML order is and how it can be used. NRML or normal margin is an order type that is used to carry forward a product in the derivative segment. Now, what is the derivative segment? The F&O in both equity and commodity is termed as derivative segment. Likewise, what is carry forward? When you buy a stock or a commodity after a few days, you carry it forward, which means you do not sell it on the same day. You can buy and sell and buy in the market, right? But in the derivative market, there is no long-term delivery. All future contracts in NSE is available for 3 months, near month, next month, and far month. And all products have an expiry date. The contract expires on that particular date. So if you wish to carry forward a product, then you must choose the NRML option. Now let's watch a live demo of how to place an NRML order. What you see on the screen is a web hunt application of Enrich. I'm selecting Nifty's April future and I select NRML. I click buy. You can see the buy window has been opened and there are 2 options enabled, NRML and MIS. Now if you're buying today and selling today, you can choose MIS. And because I want to carry it forward, I have chosen NRML. You can see that the lot size has been mentioned below and you can enter your required quantity here. You can also see the market price is reflected here. So I'm going to buy in this market price. I click buy and you can see that my NRML order has been placed. Likewise, there is no exposure limit in NRML order, whereas MIS has exposure limit as it is intraday trading. If you want to carry forward a product in NRML, there is a required margin for it. This is termed as span margin. Now let's have a look at how to check span margin on our website. Now let's take a look at Enrich website. Here you click support and choose span margin. You can see here MCX, NSE future and NSE index. And I choose NSE index. Now here in the search option, I type Nifty 50. Now you can see the span margin of Nifty 50 is reflected below. For instance, the April contract of Nifty, its span margin is 1,11,508. So we need almost 1,12,000 to buy one lot of Nifty 50 in NRML. Point to note here is that before you take an NRML position, check the span margin price in the website and make sure you have the required amount in your account before you start trading. So now you've taken a position using span margin, right? But span margin is just an initial margin. For instance, I've taken a buy position. If it moves in the positive position, then it would add profit to my account. But if it goes in the negative position, I would incur loss in my account. There would be a shortfall in my margin. So in such cases, you need to transfer supplementary margin in your account, that is, additional amount to your account in order to avoid the shortage in the margin and to maintain the requisite amount in your account. Now the brokers may allow a shortfall in the margin for a day or 2. And if you do not clear the margin shortfall on time, a margin shortfall penalty will be charged on the positions held in your trading account. And if you incur an 80% loss during the trading process, your position would be automatically squared off. So make sure to carry over your position without margin shortfall. Likewise, we can convert the NRML positions to MIS. Now let me share a trading strategy with you here. Now imagine I have an NRML position in crude oil. The span margin for this position is 1 lakh rupees and I'm going to convert the NRML to MIS. Now remember, MIS has an exposure limit. So if I take a position for crude oil in intraday, I will just need 10,000 rupees. So only 10,000 rupees is held from the 1 lakh rupees span margin. So the balance 90,000 becomes free fund. Now I can use this free fund in intraday trading. But you need to be very careful while trading in intraday and also be careful about the profit and loss. At the end of the day, I can convert the MIS back to NRML. So instead of investing further, you can trade in intraday with the position you have taken in NRML. Generally, trading is done through NRML in the future segment, and there is an expiry date for the product. But it's not so in the option segment. There are two options like the put option and the call option, and we can trade in different options like ITM, which is in the money, ATM or at the money, OTM or out of the money. Here, you need to know two major points. One is the tender period and the second is physical settlement or physical delivery. Now, tender period is used in the MCX segment. There are two types of delivery mechanism for a script in tender period. There's the compulsory delivery and the normal delivery. The compulsory delivery is 5 days before the expiry date of MCX products. These 5 days are termed as the tender period. So the physical settlement can take place at any point during these 5 days. But we cannot guess if the settlement would take place on the first day or the second or the last day of these 5 days. So to be on the safer side, all the products in the tender period are closed 5 days in advance. Now, what are the scripts to which the tender period is applicable? All the categories in gold are applicable, like Gold Mega, Gold Mini and Micro. In silver, it's applicable for Silver Mega. However, in the recent circular, Silver Mic or Micro has also been added. Likewise, it's applicable for all the base metals. However, it is not applicable for Silver Mini, crude oil and natural gas. These are the exemptions. Now, in case of physical settlement takes place in those 5 days, these products or commodities move to the warehouse to the assigned delivery location designated by the exchange. Now, you can take these products physically from these warehouses, or you can also sell them online to another buyer. Now, this process is termed as an indent order. You can sell the product under specific conditions and the buyer accepts the terms. But when you sell through indent, there's a clearing agent in between. This agent monitors physical settlement and clearing process of all the products. You can also view the location of the warehouse for each product. Likewise, this can happen in commodity option as well. For instance, I have crude oil in ITM option or in the money option. Now, if I don't cut it 5 days before, one lot crude oil will be settled in future segment on the date of expiry. But I may have purchased by paying premium. However, my settlement takes place in the future segment. So the point to note here is that the margin required to buy one lot crude oil is needed in your account. This is the settlement process in commodity. So the next mechanism is normal delivery. The delivery neither takes place in tender period nor through physical settlement. The exemptions are like crude oil and natural gas. These products can be traded till the end of the contract date. And at the end of the contract, the exchange closes off the positions based on the DDR value. DDR is due date rate. The DDR value is calculated by converting the settlement price of New York Mercantile Exchange to Indian rupees. This DDR value will be mentioned the day after the expiry date in the circular stated by the exchange. So now we have a fair knowledge of the tender period, right? Let's look at the physical delivery. Physical delivery takes place in the NSE segment. The expiry date of a particular script is March 31st. So the compulsory settlement would take place during the end of the trading hours on 31st March. But this happens only in stock option. Index option has only weekly and monthly expiry. The weekly expiry takes place on Thursdays and the monthly expiry is on the last Thursday of every month. However, if the Thursday happens to be a national holiday, the expiry is set on the previous working day. On the other hand, in the stock option, for the safety of both the customers and the brokers, it is advised to close all the contracts in ITM or in the money option 5 days before the expiry date. Let me give you an example for the margin calculation. Imagine I have an SBI stock in ITM or in the money option. Now remember, if it's OTM or out of the money option, there is no issue as it would turn to 0. But I have chosen ITM. The lot size of SBI, for example, is 500 and I have 2 lots with me. So 500 into 2 would be 1000. So the value of an SBI stock and equity is 100. So 1000 multiplied by 100, 1 lakh. So I will need 1 lakh to hold this position. So if you want to hold the stock till the end of the contract instead of closing 5 days before, you will need to have 1 lakh rupees in your account. But remember, it is better to close it 5 days before to be on the safer side. Now I've covered all the important points in NRML. If you found this video useful, please do like, share and subscribe. This is Nancy signing off from Enrich Financial Group. Thank you.